Good morning, traders. Today's the 26th of November, just after Thanksgiving holiday, and I thought I'd create this little special video to highlight the real value here at MENT.com and what you're getting. It's critically important to understand the real value that is delivered to you for free with regards to all the work that I do to try to help you and to understand what's actually taking place. Now, at MENT.com, I basically am doing this because I believe the next 5 to 7 plus years, let's call it 5 to 20 plus years, are going to be very, very critical for traders and investors throughout the world to understand what's taking place in the markets and to actually follow the data, follow the signals, follow the strategies that are taking place, and have a calm, understanding voice throughout all the noise. I read the news every day and I follow a bunch of different people, and it's very interesting to see all the different predictions about what's going to happen and how the markets are going to play out. So many people right now are predicting that the global markets are going to enter an extended downward cycle phase, very similar to 2008, 2009. And I want you to understand that the markets are vastly different from that right now. The 2008, 2009 collapse, I was speaking with my fiance just the other day, and it's amazing. People don't seem to understand. The 2008, 2009 collapse was a U.S. financial crisis created and initiated in the U.S. markets. At the time, what the U.S. markets were, and still are, the global powerhouse for economic output. Understand that if the U.S. is doing well, the rest of the world is doing well. If the U.S. is doing poorly, the rest of the world is doing poorly. And I want you to understand that at that time, we had a crisis taking place because the financial markets had gotten out of whack, hyper speculation, Fed raising interest rates, and the real estate market had gone wonky, literally wonky. With all these adjustable rate mortgages. Now, could something like that happen now? Yes, something like that could happen now, but it's more than likely going to take place in some way, shape, or form in foreign markets. For example, in Asia, in China, possibly in South America, possibly in other European countries. For example, Portugal, possibly, in London, possibly, throughout areas in Europe who have seen tremendous increases in real estate value. For example, in Canada. Canada is probably one of the best examples of some sort of a massive collapse that could take place. If you take a look at the Canadian real estate market and the valuations of Canadian real estate, it's far exceeded the U.S. and Europe by almost 2.5 times. And the interesting thing about the Canadian market, as I understand it, is the loans up there are interest-only loans, and they're normally a 3 to 5 year locked-in loans that need to swap over into 3 or 5 years. Now, you could obviously have locked something in over the last couple of years at a low rate and maybe have another 3 to 5 years to go. But for those that were sitting and didn't do anything, we now have a very real risk over the next 2+ years that higher interest rates are going to create some sort of real crisis in these foreign markets. So understand, if China market has a real estate collapse, or let's say 3 or 4 markets have a real estate collapse throughout the world, how does that affect the United States? Is it going to adversely affect the United States economy? Maybe 6, 7, 8%, maybe. Maybe it's going to slow down foreign investment in real estate and other assets. But if the U.S. dollar stays strong and the U.S. economy stays strong, capital is going to actively avoid risk areas and move to safety. Safety may be the U.S. dollar and the U.S. stock market, at least for the next 10, 12, 15 plus months until something changes. So we have a very different world right now. This is not a U.S.-based crisis. The U.S. is raising interest rates, the Federal Reserve, to try to stave off inflation. And there's early warning signs that the markets are already starting to decrease with regards to inflation. We need to see it stabilize. We need to see the devaluation of assets throughout the world and the speculative phase continue to unwind. but it's going to be done in phases. And like I said, the chance for the U.S. markets to enter into some massive collapse, okay, at this point, I see is highly unlikely. And that could be some event taking place, could be some real estate event, could be some banking event, could be some risk event globally. But even if, for example, Credit Suisse or some big European bank or some other foreign bank enters into some crisis phase, you remember that these are literally 1/5, not even, let's call it, 6% or 4% or 2% of the global economy. And it's not 50 or 60% of the global economy, which is what the U.S. market is. That's why 2008 was different. When the U.S. markets collapsed, that was the biggest economy on the planet collapsed in 2007, 8, 9, 10. Okay. Right now, if you even took a handful of these littler economies, Canada, Europe, South America, certain areas, and you saw some extended devaluation, you're talking about maybe at that point, maybe 15 or 20% of the global economy isolated in some sort of a credit or asset market collapse. It's not the same thing as the largest economy on the planet collapsing. That's why things are different. That's why you need to understand, unless the U.S. market enters into some crisis phase, the reality is the U.S. market is going to continue to outperform and is going to continue to attempt to move higher while these devaluation processes and restructuring processes of the economy continue to take place. Now, let me come over here and U.S. to global valuation trend. I believe this is it. Yep, this is it. So now this I'm going to show you real quickly. This is one of the custom charts that I send to or deliver every week to members. And this is a great example of what happened globally versus the U.S. So after 2007-8, you can see here, this is anchored at 2017, basically, the beginning of 2018. And you can see that the global markets rallied higher than the U.S. markets. From the beginning of 2018 to the peak of beginning of 2017 to the peak of 2018, the U.S. markets rallied about 22%, 27% roughly. The foreign markets rallied close to 50%, 47%. Big difference in the actual expectation of foreign market assets compared to U.S. market assets. During the collapse in 2018, end of 2018, which was Fed-driven, the U.S. markets moved from the plus 27% area back down to zero, whereas foreign markets moved from plus 47% back down here to plus 10%. So basically a 37% decline, whereas the U.S. markets moved down roughly 27%. So there was much more volatility in the global markets during this cycle than in the U.S. markets. Reason again being is the U.S. markets were more stable than the global markets. This was an excess phase. Then through 2019, we saw this rotation where the global markets didn't really appreciate, but the U.S. market did. COVID hit right here, and everything collapsed down into negative territory from the beginning of 2017. Then we had this recovery, and the U.S. markets continued to outperform global markets by an excessive amount. Why was this taking place? Okay, number one, U.S. markets were much stronger and recovered from COVID much more effectively than the global markets did. Global markets had extended concerns, extended lockdowns, and extended, credit and debt issues with regards to opening from COVID. It took a bigger hit in the global markets. The U.S. market is more dynamic. The U.S. market then entered a speculative phase. Capital was moving away from foreign assets and into U.S. assets through this strengthening phase that took place in the U.S. markets. U.S. markets went from negative 10% to plus 97% in a matter of a year and a half. A huge, massive speculative bubble took place in the U.S. markets. In that time, the U.S. markets have unwound about 50% from these excesses, going from 97% down here to 45%. So again, they've unwound about 50% of this rally phase, whereas the global markets unwound nearly all of it and ended up back down here in negative 7%. So what's happening here is the global markets have unwound a massive amount of excesses, where the U.S. market has unwound about 50% of the excesses. And why is this taking place? Why is the global market unwinding faster than the U.S. market? Very, very simple. The U.S. market is seen as a stronger, more dynamic, more stable economy than the global markets in general. So the global markets are unwinding faster. Capital is moving away from risk, and it's moving into the U.S. market assets for the strength of the U.S. dollar and the safety. So now we're at this pivot point right over here. We've seen a turn up in the U.S. market. We've seen a turn up in the foreign market. We're at this pivot point. And I believe this pivot point here in the foreign markets may indicate a strong bottom taking place or an early stage momentum base taking place. Same thing with the U.S. markets back at these pre-COVID high levels. I've highlighted these levels for many, many months now. And I believe this is the area where we're going to start to see a bottom setup, a new rally phase coming out of this. And the reason being is twofold. Number one, as long as the U.S. market avoids any type of major catastrophe, there's going to be a huge shift in capital continuing to pile into U.S. assets and undervalued U.S. stocks. That could be the mid caps, that could be the small caps, that could be miners, that could be technology. The shift is going to take place over the next 12 to 24 months. And what's going to happen in global economy is you're going to see an undervalued pop, possibly to revert back up into these levels. Then we're going to see the continued unwinding of assets take place. This is where whatever credit debt issues linger and whatever lingers with regards to foreign and global central banks interest rates and the U.S. Fed interest rates, we could see more pressure on the global markets than the U.S. markets. And that pressure in one area, think of it as global markets becoming unfavorable for investment for a period of maybe 12, 24 months or longer, is going to push capital into safety and security, which is likely going to be U.S. markets and maybe one or two other stronger performing global markets. But there is a capital shift that is taking place. And what people do not understand is it's not a U.S. crisis. It is not the global financial crisis. It is not a terrorist attack or a dot-com bubble. Yes, there's some technology bubble that has taken place, but now understand that, let me find the technology index. The technology index in the U.S. has already unwound to extreme low levels. So understand, this is part of the service that you get with MENT.com, one of my custom index charts. The technology sector in the U.S. has already unwound back to 2013-14 levels, back into this area here. We've already unwound an excessive amount of speculation. All of the growth from the deep bottom here, 2009, all the way up to 2011, 12, 13. We're now down at those levels. We've unwound all of the excesses through COVID, which was this rally here. We're way down into these very low levels, which is why I believe technology is now trying to find a base or a bottom. This could be a very good trade over the next 12 to 24 months on a reversion from these lower levels, potentially back up into these levels, 40, 45, 50. This would be essentially a 30 to 40% rally in technology sector, and it's just going to be a matter of time. Now understand, at-risk technology, if technology companies are not actually earning and they're not producing a dividend and they're not showing great revenue, then I wouldn't expect them to really rally too much, maybe 10, 15, 20%. But the bigger technology firms, like Tesla, like Microsoft, like Amazon, those are likely to recover very strongly over the next 12 to 15 months and provide a great opportunity for you once this cycle changes. We do not have that cycle changing yet because in the US, this is the custom valuation trend index monthly, we have not seen a real bottom set up in the markets yet. We're setting up a bottom right now, but we don't have any upward confirmation in trending. So understand right here from 2018 onward, we had a nice solid valuation trend, right? Upward trending. And we had it back here from 2000, roughly end of 2013, a little blip here in 15, all the way up here to the end of 2016. This is a valuation trend index. Now I want you to pay attention to how, let me come back over here. So we had a valuation trend from 2013 to 2015, 16. Then we had one from 2017 all the way up. And let me come back over to show you. From 2018 all the way up to 2020, 2021. Actually mid-20s here. So this is 19, 20, all the way through here. So now understand that the valuation trend index is really a way for us to determine core asset. So from 2018 back in this area all the way up to 2020, we saw a big valuation trend. Now let me come back over here. And here we go. So this is 2018 right here, the deep bottom. All the way up to 2020, we had this rally in the stock market. This is my custom fear timing index. Then we had COVID. Then we had the extended rally after COVID. Now this rally took place after 2020 during this devaluation phase here. We still had strength in the market. We were still trending upward, but we were in a deflationary trend cycle at that point. And then it rolled over in 2022. Roughly in January, and that is right here, 2022 in January. That is this dumping of value right here. That's where we're at right now. We've gone through a devaluation phase, a distribution phase. The U.S. market is basing and bottoming back over here. We need to see some upward trending before we're going to start to see any confirmation of an uptrend. But I do believe it is coming, okay? So now, with all of this, with the custom index, with the rotational modeling system, with the live trades algos, the TT scanner hot list, and my incredible SPY cycle patterns, really you get so much for so little. All of this is delivered to you free, okay? It's an incredible value. It's great for macro and micro analysis of the market. I focus not only on longer term trends, intermediate trends, and short term trends, but I give you real actionable trading information that you can rely upon. Not only do I give you the custom indexes, which are delivered on my live trade site right here. Oop, wrong one. On the weekly summary, I give you all of the custom indexes and my rotational modeling system, which is what we're looking at here. I'll go back to that in a minute. But all of the charts I just highlighted for you, this is last week's, are all right here, as well as my analysis of every chart. So you get everything pointing to the macro and micro environment of the markets taking place, how consumers are engaging in the market, how technology is moving, how real estate is moving here. You get also the commodity to gold index. You get the custom volatility index. You get the market cap smart cap index, the custom valuation index, the U.S. market index, which is a custom U.S. index. You get the FANGs index. You get the custom metals index. And then, of course, you get the TT scanners. TT scanners are weekly swing trading signals. These charts are designed to give you daily and weekly updates as to what to expect in the market. The real estate data is designed to give you weekly updated information. You've got 3 pages of information highlighting price trends, global data, well, actually U.S. data, not global, but this covers median listing price, active listing count, median days on market, price reduced count, and price reduction share of market. Then you get your dynamic price modeling, which is my proprietary modeling system showing you how strong the markets are. This is going back 1 year, so you can see how everything has changed from extremely positive back in January, February, March of 2022 to now extremely negative. Remember, we've went from 140% positive for market demand and plus 50% positive for pricing to negative 41% in pricing factor and negative 34% in model market demand. This is a huge shift in real estate, which I think is only going to weaken over the next 12 months. But again, there's all kinds of data here for you to really see what's going on in the market. If you're a real estate investor or a stock market investor or involved in any type of asset, this is data that you can use on a regular basis to protect yourself. Now, most importantly is the rotational modeling system. The MENT rotational modeling system is designed to protect and help you manage your retirement account. So understand, it's a very simple strategy to execute. It beats the SPY. It really does not take much to understand. We have general trending. We follow primarily the SPY. We take trades only on the SPY. We move capital away from trading when risk levels are excessive. And this is general access if you are trying to protect your capital. You can trade this with 100% of your retirement account, your 401k, or your IRA. The historical results are phenomenal. You can see here the historical results year after year have been tremendous, and it's crazy. I went and took a look at Bloomberg's hedge funds, and oh my gosh, some of these hedge funds are off, 30, 40, 50%. I read an article of one active hedge fund manager is off 72% this year, and really telling clients we're sorry, we overextended our exposure, blah, blah, blah. The long and short of it is following a proven strategy for your retirement account can greatly increase your chances of success. You can move away from risks efficiently. Look at this blue line here. Let me come in here and take a look at this. This is the SPY, the orange line, and you can see the SPY has moved in raw value from about 700 and call it 80,000 down to about 600 grand. So in theory, you've lost approximately 15-20% on just the SPY alone. Whereas the max scenario here from 1.8 million down to 1.6 million, you've lost about 200 grand. So you've lost about 8% maybe. And this is really actually incorrect, because the reality is you've lost in 2022 6.26% instead of 20% just trading the SPY, or maybe minus 50% in other assets. This is why this is so valuable. This is an incredible solution to help you manage your risks. Now, before I get sidetracked, one of the things that I was trying to show you in this video is what you get. So at MENT.com, you not only get the live trades reports, you get the live trades videos, which are here. The videos are published every Sunday. I'm actually putting them up today because I'm ahead of schedule because of the holidays. You have not only the general market rotational modeling system in real estate. This is me going through everything you need to know for the next week. Plus, you get the hot lists right here. And then you get the custom indexes right here. The custom indexes are really the guide to what to expect in the markets based on the internal factors. The hot lists are the TT scanner hot lists, discussing what trade setups are there on weekly swing trades. And then you get the rotational modeling system in real estate and general market video, which is telling you what to expect over the next 5 to 15 plus weeks with regards to the market. and how we expect the rotational modeling system in real estate, or how I expect it to play out. But then on top of that, you get some incredible daily trades with the MENT live trades algos. So let's take a look at some of these trades here. We've got Cure was a trigger just last week. It's up 1.51%. It's got decent ranking. You have TMF. It's up 4.27%. A trigger is about 2 weeks ago. It's got decent ranking. So understand, I love this ranking system. It shows you how it's performing. And if you follow my allocation levels, you can find great daily trades right over here. Very easy to find. UDOW generated a buy signal just yesterday, which was a half trading day. It's up a little bit. Moderate ranking, not tremendous, but decent. We have UTSL generated a trigger on Friday as well. Decent ranking. You can see here. 4 of the last 6 wins, 4.12 short-term ranking, intermediate-term ranking 0.35. I also teach members that you can use these as a volatility scenario. So hypothetically, this trade has a chance of a volatility range of about 2.5 to 4.5, maybe 5%. So that's pretty decent. Whereas this trade, DFEN, is up 28% from a trade about a month ago, a little over a month ago, and you can see here that it has a volatility ranking here of about 1.5 to 2% to about 5%, maybe 6%. But again, we've already taken a profit on this trade, so we've sold half of our position for a $2.40 gain, and we're already up at 2010, so it's nice solid profits. DPST was a trade trigger about a month ago. It hasn't really gone anywhere. It's got a relatively neutral ranking. So this is a positive and negative ranking. 2 of the last 6 trades hasn't really performed well. Again, the idea behind giving you these rankings is for you to be able to make decisions on how you want to trade it. I know what I would do. Looking at this historical result, looking at the ranking, I would look at this as a valid trade trigger, but only for maybe 10 or 20 or 25% allocation. And the way I handle allocation for trades, if I had, say, $1 million in a trading account and I had allocated 100 grand, which is 10% of that money, to trading, I would pull approximately 20 grand out as a cash reserve, leaving me 80 grand left. I would break that into 10 or 15 trading slots. That would mean about $8,000 per trade is what I have slotted into each equal trading slot. And because of this ranking system, I would be only trading about 20, maybe 25% of that 8 grand. That means that I would take about a 2 grand, maybe 2,500 to trade this and leave the rest as unused capital. And again, that's because of these rankings. You can see how it's performed over the last couple of years. And you can also see the ranking stats. It's won 2 of the last 6 trades. It's got, ideally, we want both positive, okay? And both of these numbers above 2.5 or 3.5 to be, nice and solid. So EDC, same type of scenario here. Hasn't really performed very well. Won 4 of the last 6 trades, both negative numbers. I would be taking only 20-25% allocation on this trade. ERXY, positive numbers. Okay, looking better. Hasn't performed very well this year, but it's looking better. A trade like this is about a month old. I would be looking possibly 50-60% allocation on this trade. FAS, trade trigger about a month ago. Both negative numbers. It's won 3 of the last 6 trades. It hasn't performed very well this year. I would be looking at 20, 25, 30% allocation on this trade. And MIDU, negative numbers, has not performed very well. I would be looking about 20, 25% on this trade. Still making money on the trade, but I'm protecting capital using this ranking system. Nail, solidly positive numbers. In fact, huge numbers. Won 5 of the last 6 trades. This is something I would allocate possibly 60, 70, 80, 100% to. Now, these volatility rankings, remember, you're looking at this and you say, okay, this may have a 60 to 70% volatility. Yeah, that could happen. Okay, so I need to understand that these could be very big bars based on these huge numbers. That's why we need to understand these ranking systems. And because of the fact that we've got these huge numbers with a win rank of 5 out of 6 trades, I would cautiously say how much of this could I withstand with these huge numbers. So hypothetically, because these numbers are so big and I don't want to see a big risk factor on this trade, I would likely trade 45, let's call it 40 to 60%, not fully allocation into this trade, because we want to see lower numbers. Let me try to find you something with a lower number. So here's, and this is a good example. So here's Nugget. We got 16.41% profit in the trade. It shows us that historically, short term, we could see roughly a 20 to 27% price swing in this trade. We're getting close to that right now. So again, because of the volatility, we may only trade 50, 60, 70%, not fully allocated. This is another big trade here. Big ranking, 1 of 5 of the last 6. This is a trade that's only a couple weeks old. We're up 7% already. This is another fairly big, 15 to 20% price swings, SOXL. It's long. Just got into a trade a couple weeks ago. Hasn't really matured. SPXL got into a trade about a month ago. Negative rankings. So again, we would want to be cautious of this. Maybe 30, 40% allocation. Here's a better trade. TECL, you see here, in my opinion, this is a better trade setup. It's got roughly a 5 to 12% volatility range. We've won 5 of the last 6 trades. It's been fairly positive. This, to me, is something where I can handle a 5 to 12% volatility range at 70, 80, 90% allocation, maybe full allocation. TNA, we've got roughly a 20, call it 21 to 13% volatility rank. The trade is about a month ago. This would, because it's got this wider range volatility, probably be 50 or 60% allocation. TPOR, negative. Big move here. Great trade, but because negative, and because of the volatility here, this would probably be only 30 or 40% allocation, simply because this negative ranking does not qualify as a solid upward ranking. We still got, great trade results, but I would rather be safe with my money than take excessive risk. TYD, we've already taken half a profit. This is a good trade. We are very moderate ranking. You can see it's performed. This is a fairly consolidated ranking numbers. So this you could trade 100% and trade no problem. UMDD, negative ranking numbers, already up 12%. Because of this, I would be looking at 30 to 40%, maybe a little less. You can see historically it has not performed very well, but we still caught a great trade here. Okay, and ideally these trades will get you in and get you out. Now remember, you have a protection level here, which is a mental protection level telling you that when we get into the trade, this is the area we want to watch for real risk. Then you have a physical hard stop level, which will come into play. Let me show you on something that's a newer trade. So here we have a physical hard stop level that's taken place at the protection level. And once we hit our target, like we had up here, fine, here we go with a target. So we got in at 29.01. We got in at 11.9. Okay, we had a physical protection level at 29.30. We had take a profit at 33.38 for half. We're at 33.77. We're still profitable. We now have a physical hard stop level at 29.01. When we get into new trades with the TT algo, the TT trade tank live trades, MENT live trades, you'll see here when we get into a new trade, there is typically no hard stop level. We let the trade do what it does and execute with no physical stop. We use the trade protection level as a mental crisis level. If we get below 108.88 on this trade, then we have to start really considering where we're at on the trade, and the system will manage it for us. When we get into a trade where the stop level kicks in, what's happened is, I'm going to the first one here, we've either moved sufficiently up to a target level, or we've moved sufficiently through a threshold where the stop level kicks in and says, hey, we need to start protecting this trade. And that's where this stop level kicks in. Now, what you do with these trades, remember, there's hundreds of these out here. So let's go to the 2X ETFs. And you can see this is CHAU. We're at 1818. We're very close to the protection level. We had moderate ranking. So again, this would have been probably 70 to 100% trades. We're at 9.87%. If you had broken it down into the 10 to 15 trading slots, like I recommend, this would end up being a minus 0.9% loss, about a 1% loss right now. In the LTL, we've got a trade from 1125 just yesterday. It's minus 2.68%. We have moderately low ranking, so this would have been about a 30 or 40% trade of allocation. And this is, again, going to be a 0.15% potential loss, maybe less. QLD, we've got fairly solid ranking. Decent, looks good. This could have been a 70 to 100% allocation, depending on what you did. We have a 2% loss in the trade right now, but it's holding its own. We have no stop. We have a 37.94 protection level. We're at 41.11. We got in at 41.96. So again, this may have been literally a minus 0.2% loss, 0.2% or less, depending on how many slots you have. And that's how the system works. Now, there's a new feature that's a couple months old called Pure Alpha. And Pure Alpha is designed to rank these short-term performance results, giving you what are likely to be the best performing stocks based on these ranking systems. Now, the markets are a bit sideways, a bit flat. So you can see we're going to have a couple of triggers. This is a brand new trigger here. This is a trigger that's about 15 days old, and it is under a little bit of pressure. But these are the strongest performing Pure Alpha trades. Let's come over here to the hot list, the core ETF, Pure Alpha. And you can see, again, we've got a short trigger here in DBC. It just happened yesterday. A DIA, a long trigger, just happened yesterday. XLU, a long trigger, happened yesterday. MJ, a long trigger, happened about 2 weeks ago. We have a protective stop level at 508. PBW, a trade about 2 weeks ago. We've already taken half, so we've had a decent profit. And we have a protective stop level at 43.83. Pure Alpha trades are designed to be extremely valuable for you, and they're on every single item here. Now, these are daily, so understand when you're looking for daily trade triggers, coming in here and looking for Pure Alpha setups are probably very good opportunities for you to try to capture some big trades. You can, of course, come back to the standard, and you can look at the new triggers. So understand, these are all triggers, not just Pure Alpha. These are triggers to go flat. So this is AMC, was in a trade and went flat. So we had a trade to get flat on 11/17. We had actually an entry trade trigger here. We took half, and we can actually come in here, and you can see the details. The last trade was on 11/14 at 734. We took a profit at 856 for 16%. We sold the other half of the position at 739 for a little bit of a profit. Net was 63 cents or 8.62%. And you can see how the system is performed on AMC here. And this is available to you with all results. So here is a negative. This is probably going to show a negative trade result. Yep, negative 11%. Remember, you have to put this into perspective. This is only negative 1.1% if you're using 10 trading slots, or negative 0.75 if you're using 15 trading slots. So you have to look at these numbers and understand that this is only one of the trading slots that you're using. And again, did this qualify as a pure alpha trade? Probably not, because of these negative rankings. So that wouldn't have qualified as pure alpha. This is an exit on 1125. Obviously, it hasn't performed very well in FA. FDX, we had an exit here, 1117. So these are all the newest triggers, and you can see what's going on. SHD, we had some triggers here. This wouldn't have qualified for pure alpha as well. You can see we had a 6% gain, a 4% gain, a minus 0.26, minus 3.2, minus 4.9, and minus 4.8. So in theory, ladies and gentlemen, this would be a minus 0.4, a minus 0.5, a minus 0.32, a minus 0.026, a positive 0.46, and a positive 0.63. So in essence, trading this over the last couple of months has net resulted in maybe a minus 0.8% loss. And again, these were not pure alpha trades. This is showing you how the trading system works and how you should allocate them. Now, when we get into, and let me come up here, real strong trending, you will see this in two forms, okay? You will see this here is the SPY weekly will be bullish and the SPY daily will be bullish. That will give us a strong indication that we should be looking for upward trending live trades triggers. And additionally, we will be fully 100% allocated likely into our SPY position with the rotational modeling system. But additionally, we'll have very strong trade triggers here through the custom index charts. I will be advising you that things are looking good, markets are moving higher, we have confirmation, we can now become aggressive with our capital and try to trade the trends. In the meantime, when things are neutral like they are right now, this is why these trading systems, and remember, we have our allocation levels here. 10% stocks, 65% cash, 25% metals, 0% bonds. This is our primary allocation table. This is our alternate allocation table for those who can't hold metals in their retirement account. 10% stocks, 90% cash, 0% bonds. Ideally, if you're following this allocation level, you will only be trading with a very small percentage of your capital, and that's why these daily trades really don't amount to massive gains or losses. You want to be protecting cash right now. When the system changes back into a solid trending, bullish daily, bullish weekly, then we will become more aggressive with the system. And right now, we're just not seeing really strong trending in either direction. We're getting fairly neutral, mixed direction trending. But again, the real value here is not only do you have the TT scanners on the live trades, you have the videos every week, you have the weekly summary with all the custom indexes, you have the MENT live trades setups, you have not only that, but you also have all of the TT scanner weekly swing trades here that are incredible weekly swing trades to be able to use, as well as the new SPY cycle patterns. And the SPY cycle patterns are really incredible. I've mapped out cycle patterns from a critical time price inflection point, which is really, if you follow GAN, WD GAN type analysis, and I've identified what's going to happen all the way out to 2030 right now, so 7 years out into the future. These are on a daily basis, and they provide you a massive amount of knowledge as far as what's taking place. In fact, if I come over here and here to here and here, just to show you, these are my semi-organized, where is it? Fib, nope. Custom market timing. Oh, cycle patterns, and this should be it. Yep, this is it. These are my cycle patterns for the next 4 months. And you can see here, I've mapped out pretty much everything from December all the way to almost the end of April as to what's going on. And you can see by looking through here, we have flat down Harami, temporary bottom, gap potential, top, flat down, breakaway, carryover. Highlighted in these bold patterns is what I believe is critical. Temporary bottom, top resistance, consolidation, temporary bottom. Then we have a momentum rally, gap lower. So this, it could be very important. Then we have a momentum rally here. Then we have rally, rally, rally. This is an early January. So we have really some moderate melt up through December with these momentum rallies and bottom setups. In early January, we have a big rally phase, which could set the trend. We have a major crush pattern on January 13th. Major crush and crush are big ranging bars. Notice this big bottom sets up here. We have a very interesting. We have rally, 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 rally. Carryover, which means probably a carryover, just moderate melt upward. Inside breakaway, probably to the upside, maybe a pullback. We'll have to see. Harami inside day. This is just a neutral sideways day. A huge crush pattern, a bottom, and then a major crush pattern. Then nothing, then gap potential, gap reversal, breakdown. So this would be rally, rally, rally upward, big move, some kind of a big volatility event taking place here. Then we get gap, gap, breakdown, pop, then nothing, then base rally, breakaway, rally, okay, then carryover, inside bar, Harami, then another crush bar, then a reversal rally, then a couple of days of nothing, inside breakaway, breakaway, rally, rally, carryover, crush, reversal rally, more rallying into early February. Then we get some neutral here with a crush pattern, gap, gap, rotation, top resistance, consolidation, inside breakaway, breakaway, crush, flat down, pop. Then we get base rally, Harami, crush, bottom, major crush, again, setting up just like back over here. So this could be another very strong push near the end of February. Then we see this carryover into the end of March. Remember, as we near the end of March, we're going to be nearing the end of Q1 2023. And look at how this sets up. We get a momentum rally, gap up, breakdown, rally, carryover, temporary bottom. Then it floats downward into a moderate sideways melt up, it looks like. Then we get a temporary top, flat down, breakaway, rally, weekend gap, gap up lower, breakdown, momentum rally. And that sets us through the end of Q1 into April. And into April here, you can see we have rotation, rotation, crush, gap, gap, temporary bottom. I mean, these are all mapped out for you every day, 4 months in advance. You can see what's going to happen, and I can do this all the way out to 2030. So this tells us, gives me an idea by looking at these scenarios and looking at these trending. I'm seeing a lot of bottoming and a lot of breakaways and a lot of momentum rallies. And I'm seeing a couple of little tops. So what that means to me is we're going to be melting upward and then top resistance, then melting upward, top resistance, melting upward, top resistance. The little upward price waves that happen throughout an extended rally phase. And that's why I believe we're going to see this really take place. The real scenario here is that December is going to be, like I said, December, basically between the 5th and the 10th, I believe we're going to set up a solid bottom, and we're going to start to rally through the end of the year. Okay, then we're going to see some sort of a topping formation near the end of the year, some rotation, some downside, and then in early January, we're going to get rally, 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 rally. That's going to set us up for a very strong early January push to the upside, which will end sometime around the 24th, right in this area, 24th through the 27th. We could get a crush. We could get a reversal rally, inside breakaway. And then we'll start another rally phase in February. Then we get a top resistance February 14th. This could be a big pullback. Then by the 19th, we start moving into the crush, flat down, pop, rally, harami, crush, bottom, major crush. This is the end of February. Then we get this gap potential, carryover, crush pattern. I see this as bullish, bullish, bullish. Flat down, momentum rally, gap up, breakdown. These will be a gap up, pullback, rally phase, carryover, temporary bottom, gap reversal. So this is going to be right around mid-March. We get some consolidation and an upward trending. Then we go into a sideways kind of a flat mode, initiating a rally on March 18th, carrying upward until the end of March, where we start to get into this topping pattern. And I believe we'll start to get some rotation and some bigger gaps here as we move into Q1 earnings. Eventually, I believe this is going to bottom out and it's going to form some sort of a really solid base for a Q2 rally off of Q1 numbers. But we could see a lot of momentum back over here. Okay, so I'm trying to provide you some excess information. This is a bit of a long video, but I want you to see the real value taking place here and how to use this. Remember, there's a lot of talking heads out there talking about all kinds of things. In my opinion, follow the data, follow the systems, follow the signals, and you should be just fine. Visit MENT.com, sign up, create your account. Let me come over here. Sign up, create your account, learn how to use the tools I'm providing you, because these are incredible solutions to help you trade and protect your assets going forward. And I want you to really pay attention to what's happening in the markets. All right, guys, thanks a lot.